The myth is that small-cap stocks are always riskier than large-cap stocks. A recent study using advanced quantitative analysis reveals that in 37% of cases in the last 20 years, the top 10% performing small-cap stocks actually had lower betas than their large-cap counterparts. We show you how to pick them. So what exactly are small-cap and large-cap stocks? It's all about market capitalization, which is basically the total value of a company's outstanding shares. Small-cap stocks are those of companies with smaller market caps, generally ranging from $300 million to $2 billion. Large-cap stocks, on the other hand, belong to companies with market caps of $10 billion or more. Let's talk about small-cap stocks first. They are often seen as having higher growth potential. Think of them as smaller, more agile companies that can quickly adapt to new market trends and opportunities. Because of their size, they sometimes can grow their earnings and revenue a lot faster. But here's the catch. Small-cap stocks can be more volatile than large-cap stocks. This means their prices can go up and down more dramatically. They can also be less liquid, meaning it might be harder to buy or sell large quantities of shares without affecting the price. You need to consider that their financial health is often less certain than that of larger, more established companies, making them riskier investments. For example, a small tech company might have a groundbreaking idea, but it could also quickly run out of cash if its product doesn't take off. Now, let's move on to large-cap stocks. These are the giants of the stock market, well-established companies with a long track record of success. Large-cap stocks tend to be more stable and reliable investments. They often pay dividends, providing investors with a steady stream of income. They are generally less volatile than small-cap stocks, making them a good choice for investors who are nearing retirement or have a lower risk tolerance. But with stability comes slower growth. Large-cap companies are already so big that it's harder for them to grow at the same rate as smaller companies. Imagine a massive oil tanker versus a speedboat. The tanker is stable, but the speedboat is much faster. So, which should you own? It really depends on your individual circumstances. Think about your risk tolerance. Can you stomach the ups and downs of small-cap stocks, or do you prefer the steadier performance of large-cap stocks? Consider your time horizon. If you're young and have many years until retirement, you might be able to take on more risk with small-cap stocks. But if you're closer to retirement, you might want to focus on the stability of large-cap stocks. Also, think about your investment goals. Are you looking for rapid growth or a steady income stream? You should consider diversification. Investing in a mix of both small-cap and large-cap stocks can help you balance risk and return. A well-diversified portfolio spreads your investments across different asset classes, reducing the impact of any single investment on your overall returns. Remember, market conditions also play a role. Small-cap stocks tend to outperform large-cap stocks during economic expansions, while large-cap stocks often hold up better during recessions. To help you analyze stocks, look at things like the P/E ratio, which compares a company's stock price to its earnings per share. Also, check out their debt levels to see how much debt they have compared to their equity. These valuation metrics can give you a better understanding of a company's financial health and potential. One question that this video did not explore are the effects on international and global financial performance. Are developed markets better for small cap or large cap? Another problem not discussed are which market sector suits small cap or large cap better. If you found this video helpful, please give it a like, share it with your friends, and subscribe to our channel for more informative content. Thanks for watching.